Hello and welcome to another episode of Full Court Finance here at Zacks. I'm your host, Ben Rains, and today we're diving into two market-moving tech giants before they report their quarterly earnings this week. And we're looking at Apple and Microsoft specifically to see if investors should maybe think about buying either of the soaring tech stocks before they report earnings. But before we get into everything, remember, if you have any questions or episode suggestions, please feel free to shoot us an email over at podcasts@zacks.com. Also, make sure to subscribe and leave a review wherever you listen to your podcasts. And make sure to check out our new zacks.com/promo page for a look into some of our services, portfolios, and more. So before we get into Apple and Microsoft specifically, I would be remiss if I didn't quickly talk about what's moving the market today. So the Dow, S&P 500, and NASDAQ all tumbled Monday morning as concerns about the coronavirus continuing to spread have really grown over the weekend. So all three indexes are poised to have their worst day since October. Meanwhile, the benchmark 10-year U.S. Treasury fell to 1.615, also on pace for its lowest closing level since October. So this is all happening as cases of the virus, which started in China, have now been found in the United States, Australia, and France. And the virus has affected roughly 2,700 people and killed at least 80. And this is based on the most recent numbers. And the number of cases in the U.S. has risen to 5, and the government is working to evacuate citizens from the epicenter in China. So that's what's going on at the moment with this larger macroeconomic picture, and these fears could continue to hover over the broader economy and market until there's some semblance of an end in sight. No one's really sure about that yet, but I don't want to speculate on anything more than what we know at the moment. So that's just a picture of what's hanging over the market as we head into the really busy part of fourth quarter earnings season, especially for the big tech companies. So now we're going to jump into the two companies we're going to talk about today, which are Apple and Microsoft. And these two companies are actually larger combined, are larger than nearly 200 of the smallest S&P 500 companies combined. So they're two market movers. The last year, the S&P 500 is up big, and these two companies are responsible for a decent amount of that movement. Apple's market cap sits at nearly $1.4 trillion, while Microsoft sits at about $1.23 trillion at the moment. And in fact, they are the only $2 trillion firms in the U.S., and that's after recent newcomer Google parent Alphabet fell out of the club pretty quickly after entering the fray. So now we're going to dive quickly into Apple to see if investors should think about buying the stock, or just what to assess of Apple before they report their Q1 earnings for fiscal 2020. And this is after the closing bell tomorrow on Tuesday, January 28th. And obviously, Apple doesn't need that much of an introduction, so we're just going to give the basic layout of what's going on with Apple at the moment and what investors need to know in sort of the quickest way possible, the general case for Apple stock. So Apple shares have skyrocketed nearly 100% in the last 12 months and have slipped recently along with the rest of the market. So they're down about 3% as of Monday. But overall, it's been a spectacular year for Apple, even though its key iPhone business did slip in general. So now we're going to just break down kind of the case for Apple. So Apple's non-iPhone business has become the focus on Wall Street in recent years as sales of its flagship smartphone continue to slip. But still, despite that, the Cupertino, California-based company relies heavily on the iPhone. The device has helped propel Apple to its massive $1.4 trillion market cap since it launched in 2007. And today, customers around the world still consistently shell out over $1,000 to buy new iPhones. And so far, Apple executives have been pretty pleased with the early success of the iPhone 11, which came out this past fall. And already looking ahead, analysts and tech insiders are predicting that the iPhone 12, which will be launched in the fall of 2020 most likely, is expected to feature some of Apple's most game-changing updates in recent years, which also likely includes its first 5G phones. So with all that, in Wall Street really focusing on its non-iPhone business, iPhone sales still accounted for about 55% of total revenue in fiscal 2019. This did, however, mark a decline from 2018 when the iPhone accounted for about 62% of sales. So that big year in 2018 when iPhone sales were up big with the launch of the iPhone 10, accounted for about 60%. In the last year with the sales down from that big jump in 2018, iPhone sales accounted for 55%. So along with their standard iPhones, recent reports suggest that Apple will start to produce what they're calling a low-cost iPhone, and this is to help possibly address the rapidly expanding low-cost smartphone market that's really booming in places like India, in China, and beyond. So it's unclear exactly what the price of quote-unquote a low-cost iPhone will be, but it certainly will be interesting to watch what comes from that. So obviously the iPhone remains a really big part of their business. So despite Wall Street saying that their focus is on services and wearables, they can't continue to see a really big slowdown in iPhone sales without really affecting its top and bottom line. So continue to watch out for the iPhone 12. Maybe these lower priced iPhones will help create a little bit of a comeback in 2020. But now we're going to get into what lots of people are talking about, and that's their services and wearables business. And their services segment features its widely popular App Store, Spotify Challenger, Apple Music, and more recently they've rolled out a subscription-based video game service, a credit card, a magazine-heavy news service, and then the big, much hyped service that came out in November was their streaming TV platform, and that's Apple TV Plus. It features some big Hollywood stars both in front of and behind the camera, and some of those shows have gotten some critical buzz early on, and they're going to continue to roll out a smaller number of shows to help build up that content library and hopefully compete long-term alongside the Netflixes and Disneys and Amazons of the world. And that service is only costing $4.99 per month. So that really could help attract users to that service, since $4.99 is much less expensive than Netflix at the moment. And that comes also along with its kind of smaller, well, not kind of, it's much smaller content library at the moment. In the general plan long-term for Apple seems to be that they're trying to generate more revenue from their roughly 1 billion active devices out there. So last quarter, Apple's CEO said that they have 450 million paid subscriptions across the services on their platforms, and this was compared to 330 million a year ago. So they jumped 120 million paid subscriptions over a year, and he also said that they are, quote, well on their way to passing their goal of surpassing the 500 million mark during 2020. So they're going to get up to 500 million subscriptions during this fiscal year. And then along with their services business, Apple's wearables business has also thrived recently, and this has been driven by those AirPod wireless headphones that you see everyone wearing these days. Kind of like when you first saw the iPhone, these AirPod headphones are everywhere, those wireless general white Apple headphones just without those cords, and they've been widely successful. And then also the Apple Watch, they've continued to pack more health-focused features in that smartwatch, and down the line maybe that could be a bigger part of their business. And I think the success of Apple's Apple Watch is a big part of the reason why Google decided to buy Fitbit, because they've seen the success of that product for Apple. Now we're going to go ahead and take a look at what to expect this quarter, and then sort of overall for fiscal 2020 and fiscal 2021 for Apple. So last year, their overall revenues dipped 2%, and this is after they climbed 16% in 2018. So not really. It more just came against a hard to compare period. And despite the overall decline, sales began to pick up in the second half of 2019, which sets up some momentum for this year and next. So looking ahead to this current quarter, the one they're about to report tomorrow, Q1 of 2020, sales are projected to climb about 4.1% based on our Zacks estimates, while its overall 2020 revenues are expected to climb about 6%, which would then see it easily top 2018's figure. And then if we look ahead to 2021, their sales are expected to climb another nearly 9% above our 6% figure this year to reach almost just under $300 billion in revenue in fiscal 2021. And then in terms of their individual business units, our key company metric estimates are calling for Apple's services business to jump roughly 16% this year, so for fiscal 2020, to nearly $54 billion. So they're expected to climb 16% from 46 to about $54 billion. And this would roughly match last year's 17% expansion in that key services business. And it's going to start to account for much more and more of the company's sales. So last year it accounted for about 18% of sales, which easily made it the second largest unit behind the iPhone and worth more than Mac and iPad combined. And then if we look on the wearable side, their business unit is called Wearables, Home, and Accessories. And that's obviously other devices are thrown in there along with AirPods and Apple Watch and all of that. The unit is projected to climb 27% this year, which would come on top of 2019's 41% expansion. So we can see that services and wearables are expected to drive that overall growth. And obviously we can't forget about the iPhone. So in fiscal 2020, sales are expected to climb marginally from the year ago period. So returning to a little bit of growth in that iPhone business is obviously something that Wall Street and investors will be happy to see. And then at the bottom end of the income statement, Apple's adjusted Q1 earnings are projected to climb about 8.4%, with full year earnings expected to jump nearly 11%, and then another 17% higher in 2021, according to our estimates. So some solid top and bottom line growth for Apple after a little bit of a slowdown last year. And then if we look in terms of kind of the broader picture of some of the other basic fundamentals of the stock, its valuation has grown a little bloated as its stock price continues to soar. So just for a quick note, Apple was trading at about just around $151 per share in January of 2019, and it surged all the way to new highs of $323 per share late last week. So that's that big jump. And along with that big jump has come a little bit of a stretched valuation picture. It's trading at about 23 times forward 12-month earnings estimates, which marks a 10-year high and comes in far above its 15.3 median over the past 3 years. But Apple's not alone in this stretched valuation. The S&P 500's valuation is pretty stretched, and its fellow trillion-dollar market cap buddy Microsoft is also trading at right near its 10-year highs. So obviously people are a little nervous about this valuation picture, so it will continue to see if a pullback is in order, and maybe this Chinese virus scare will end up sort of acting as this pullback that maybe had to happen at some point as the valuation concerns continue to grow. We should note, though, also Apple is a Zacks ranked number 2 buy at the moment based on some solid upward earnings estimate revision activity. And Apple is also a dividend payer, paying a yield of about 1% at the moment. And as most people know, they're sitting on a giant pile of cash. They're continuing to buy back shares. And this is based on they continue to buy back shares as their plan is to. This is based on last quarter's earnings report and their conference call that they plan to, quote, continue to buy back shares on a path to reaching net cash neutral position over time. So they're going to continue to buy back shares, which is obviously good news for investors. And once again, Apple is expected to report its quarterly results after the closing bell on Tuesday, January 28th. And obviously, with all that's going on, it might be a little harder to play stocks around earnings with the overall market uncertainty. So I would, if you don't own Apple now, it might be best to just stay away, see what they guide looking ahead to the rest of the year, what they say about iPhone sales, anything new to report, and see if even if they blow out earnings and blow out guidance, there could be a little bit of a post-earnings pullback just based on investors taking home some profits with Apple stock up so big. But obviously, there's no way to really know what will happen, and that's what makes this all so interesting to watch. So Apple once again reports its quarterly results after the closing bell on Tuesday, January 28th. And now we're going to do the same thing that we just did with Apple for Microsoft. And like Apple, Microsoft doesn't really need that much of a detailed background. So we should note that Microsoft shares are up 55% over the last 12 months. And just like Apple and a lot of other stocks, they slipped recently along with the broader market. And Microsoft's pitch these days is relatively straightforward. Microsoft is one of Amazon's largest competitors in the growing and vital cloud computing space. Last quarter, intelligent cloud revenues were up 27%. This easily topped its fourth quarter cloud jump. And overall, last year, fiscal 2019, their cloud revenues were up 21%. In their cloud computing business will continue to be a big focus of Wall Street. But just as the services business has become a big focus for Apple and cloud computing is a big focus for Microsoft, their other divisions have done really well, kind of maybe under the radar. So their Office and Windows units and gaming units kind of continue to evolve and expand. And their big purchase of LinkedIn has proven to work out pretty well so far, and they also continue to try to expand into everything from artificial intelligence to Internet of Things products and all of those other buzzwordy tech spaces that you hear about all the time. And they've also managed to remain relatively out of the government spotlight, which is a good thing for investors, while Google and Facebook and some others, even like Amazon, have found themselves in trouble. And obviously, Microsoft already had its big day in antitrust court years ago, so maybe they won't be having to deal with anything more going forward. So obviously, that's a good thing for investors. And as we just mentioned quickly with Microsoft, they're trading at about 29 times forward earnings. This represents a small discount compared to its industry and just below its recent highs, but it's still far above its 3-year median. And as we mentioned, for all the same reasons with Apple, its valuation is a little bit stretched, but also like Apple, it continues to return value to shareholders through buybacks and dividends, which it consistently raises. Last quarter, they raised their dividend by 11% for fiscal 2020 and announced a new massive share repurchase program. Their annualized dividend yields about 1.2% at the moment, which is below the 10-year U.S. Treasury, but above Apple's 1%. And looking ahead now to what to expect for their quarterly results, our estimates are calling for Microsoft's adjusted Q2 earnings to climb 20% on 9.9% higher sales. So we're calling for 20% and 10% growth on both the bottom and top lines for this upcoming quarter. And we should also note that Microsoft has a strong history of quarterly earnings beats, just like Apple, which I forgot to mention. And this includes beating bottom line estimates, our bottom line estimates, by about 10% over the trailing 4 periods. And then over the longer term, so Microsoft's currently in their fiscal 2020 year, we're calling for their revenues to climb just over 11% and then another 10.5% growth in fiscal 2021. And this would come in slightly lower than what they've done in 2019 and 2018, but look really strong compared to 2017's just 6% top line growth. And then on the bottom line, we're calling for about 13% growth this year and another 12% growth in 2021. And then overall, another thing we should quickly note is that the company's cloud computing revenues are expected to continue to drive that big sales growth, with their fiscal 2020 cloud revenues expected to climb 21% to roughly match what they've done last year. And at the moment, Microsoft is a Zacks rank number 3 hold heading into its Q2 fiscal earnings release, which is due out on Wednesday, January 29th after the closing bell. And like with Apple, it might be best to, if you don't own Microsoft, to stay away until after earnings to see how Wall Street assesses their upcoming report and their guidance. And the stock is up so big, its valuation's a little stretched at the moment, that even if they have a blowout earnings, there could be, once again, a bit of a pullback as investors try to take home profits. And with the virus concerns kind of taking over the picture at the moment, it might be just best to kind of wait on the sidelines. But obviously, it's worth further consideration on your part. But we have 2 big market movers reporting with Apple and Microsoft, and we also have other big tech names, Facebook, Amazon, others reporting this week. So it'll be a big week for tech earnings. But that does it for another episode of Full Court Finance. Until next time, I'm your host, Ben Rains. And remember, if you have any questions, please feel free to shoot us an email over at podcast@zacks.com.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.